Now, some call it hype, and some others say that ESG is the future of investing. So, what is it in reality, and why should investors care?
So India is really at an inflection point, Arjun. On one side, we have the world's third largest greenhouse gas emitter. But on the other side, we're also one of the fastest growing economies. But there's an unprecedented wave of urbanization that's going to reshape how 600 million people are going to live and work over the next 2 decades.
I've also heard a lot of negative news of late about ESG. I hear that some funds have underperformed or seen outflows, and there are concerns about greenwashing.
And the truth is that the story hasn't been all smooth. There is geopolitical pushback from some quarters, and there are concerns about greenwashing, which have all made investors very cautious. But I'd frame this as a healthy correction and not a retreat.
I hear that India's opportunity is quite significant. Is that true?
India's climate opportunity is no longer just about solar parks and EV sales. The next frontiers are efficiency, heavy transport, decentralized renewables, waste, water, and so on. And all these sectors are investable, undercapitalized, and waiting for disciplined capital.
Market Tali was brought to you by Sundaram Alternates.
Welcome back to Market Talaivas. Stay tuned for an in depth discussion packed with valuable insights to help you navigate the ever evolving market terrain. I am your host, Arjun Nagarajan. In today's discussion, we shall dive into one of the busiest themes in the markets at the moment: sustainability, climate finance, and ESG. Now, some call it hype, and some others say that ESG is the future of investing. So, what is it in reality, and why should investors care? Let's step back a bit now. The defining challenge of our time is climate change. Now, when we talk about climate change, it can sound fairly abstract: degrees, targets, deadlines, etc. But the reality is anything but abstract. India has faced record heat waves, devastating floods, and billions in economic losses. Globally, scientists warn that if the planet warms more than 1.5 degrees Celsius above pre industrial levels, we would face severe and irreversible damage, from unlivable heat to ecosystem collapse. We are already at about 1.2 degrees today. And this leaves us with very little room and very little time. To stay on track for this very 1.5 degrees, the world needs to cut emissions nearly in half by 2030. And this requires trillions of dollars in new investments every single year. And this is where climate finance comes in. How and where we allocate capital will determine whether we build a sustainable, resilient economy. Now, climate finance tells us that while we do just this, we can still deliver competitive returns. So, the big question is, how do investors really think about climate finance? Where is the momentum coming from, and what does it mean for India? To help us unpack all of this, I am joined by Mr. Ramtej Bolisetty, ESG officer at Sundaram Alternates. Hi Ramtej, wonderful to have you with us here. I have quite a few questions for you on ESG so that you could help us demystify ESG for our viewers. There's a lot of buzz in the markets about ESG and green investing these days, especially concerning climate change. Can you explain what that's all about? More importantly, can you please tell us what is it that is driving this ESG momentum?
Sure. Thank you, Arjun, for setting the context. So let me start by acknowledging something obvious. And it is the fact that we've all experienced the impact of climate change in our daily lives. And one way it presents itself is in the form of extreme and unpredictable weather patterns, which have become more and more frequent in the recent years, right? So this year, India saw the hottest February and the wettest May in over 125 years. Even as we speak, several parts of India are reeling under flood-like situation. In just the past year alone, such extreme weather patterns have caused losses of over 1.5 lakh crore. Now, these aren't just headlines about the environment, right? They're showing up directly in our balance sheets. One industrial client told us that their cooling costs jumped nearly 30% during the heat wave this year. So, when the offices flood, the productivity is impacted, and when the crops fail, food prices rise. When there is heat wave, healthcare costs climb. So, to put simply, climate risk has become a financial risk. And that's why sustainability and climate finance has moved from the margins of policy to the very center stage of global capital markets today. And the numbers back it up. Globally, the climate finance flows have already crossed $1.5 trillion per annum. And that's more than double of what it was just 5 years ago.
Wonderful, Ramtej. That explanation was very relatable. But then that takes me to my second question. Why is there this sudden surge in ESG then?
Why this surge? We attribute it to four key factors. First one is that most of the investors are now acknowledging climate as a legitimate risk and they are factoring it into their models. This risk is now being priced into valuations, credit spreads, and insurance. Number two, global practices are rewriting the rules. Years of global coordinated effort to streamline rules on ESG are now bearing fruits. We have clearly defined net zero targets. There is clarity on carbon pricing mechanism, and there are a set of robust disclosure standards which have provided a great deal of clarity for the stakeholders in this space. Number three is product innovation. So, from green bonds to transition bonds to sustainability linked loans, there's now an entire toolkit that makes investing in climate solutions mainstream. And number four is the performance. So, data shows that green portfolios default less and perform better, especially during the volatile times. So, it is the convergence of all these factors that are setting the stage for the growth momentum in this space. But here's the kicker, Arjun. We're still severely underfunded. To stay on a net zero path, the world needs $5 trillion of investment every year. And right now, we're at less than one third of what is required. So, in other words, for every dollar that's being invested in climate, two are missing. And that is the gap where the biggest opportunities lie for the investors in this space.
Very interesting. It sounds like momentum is indeed quite strong. But I've also heard a lot of negative news of late about ESG. I hear that some funds have underperformed or seen outflows, and there are concerns about greenwashing. Can you break all of this down for us? What's happening in ESG investing right now? And as our ESG officer, I think there's no one better to explain this and break it for us.
Well, that's a fair question, Arjun. And the truth is that the story hasn't been all smooth. There is geopolitical pushback from some quarters, and there are concerns about greenwashing, which have all made investors very cautious. But I'd frame this as a healthy correction and not a retreat. So let me tackle three myths that I hear very often. First is that ESG is just marketing. So while greenwashing is real, the response towards it has been tougher standards, which includes transparent measurement, independent verification, and legal governance. Investors are demanding hard proof now, and that weeds out weak players and rewards the ones delivering real outcomes. Myth 2, that sustainability is not rewarding, and that's not accurate. Funds that slapped on ESG label without bringing in any change to their portfolio have struggled, yes. But when ESG is done properly, with enforceable standards and real integration, the returns are often more resilient, especially in volatile markets. And we've seen this playing out in our own portfolio. And the third myth is that ESG is a Western fad. Climate risk is most material in Southeast Asian economies. So when floods shut down a factory or a heat wave cuts crop yields, the financial hit is immediate. So, ESG is not a Western fad, but we should view it as an essential risk management tool. So, all in all, what you're seeing isn't ESG collapsing, it's investors moving towards quality. Capital is flowing to managers and projects that can show measurable outcomes. And the scrutiny is good. It strengthens the market by pushing out the lazy practitioners.
Let's now shift our focus to India. How does India fit into this global climate finance story, if I can call it that? I hear that India's opportunity is quite significant. Is that true?
So, India is really at an inflection point, Arjun. On one side, we have the world's third largest greenhouse gas emitter. But on the other side, we're also one of the fastest growing economies. But there's an unprecedented wave of urbanization that's going to reshape how 600 million people are going to live and work over the next 2 decades. The way we grow and the way we finance that growth will shape not just India's future, but the world's climate future. And the government has laid bold goals. So now, India's mobilized around $30 billion into climate and renewables last year. And that's a huge leap from almost nothing a decade ago. So, where is this money actually flowing? It's going into two major sectors. One is renewables, such as solar and wind farms, and second is electric mobility. These sectors have pocketed close to 70% of the climate flows that we're talking about. And that's changed the scale at which these industries operate and have made it mainstream to the economy. But here's the problem, Arjun. There are several sectors which have remained underfunded as a result. Especially when we view it from a credit lens, there are opportunities for investors in a lot of different sectors. Now, these are the sectors where technology has matured and there is sufficient demand, but the companies are starved of growth capital. So, if we were to look at it, we look at opportunities in these 4 5 segments, right? So, first is efficiency and mobility. Now, obviously, this industry is huge as it contributes to 30% of India's emissions. But the fixes, such as efficient motors and waste heat recovery systems, often pay back in 3 to 4 years, but somehow they rarely get financed. We also see opportunities emerging in the decarbonization of heavy transport, such as buses and logistic fleets. Now, these are tailor made for structured credit linked solutions to measurable outcomes. Second is green buildings. Now, green buildings and construction contributes close to 30% again of India's emissions, and this is huge. We've seen penetration of green buildings in commercial segments in a few cities, but largely the housing remains untouched. And that's where we see a lot of potential to fund this climate transition. Number three is circular economy. Now, India produces close to 62 million tons of waste a year, and most of it isn't scientifically processed. Recycling plants, bio-CNG units, waste to energy projects, they are generating real cash flows but are starved of capital. So here's the investor takeaway, Arjun. India's climate opportunity is no longer just about solar parks and EV sales. The next frontiers are efficiency, heavy transport, decentralized renewables, waste, water, and so on. And all these sectors are investable, undercapitalized, and waiting for disciplined capital.
Wow, that is quite an opportunity. Let's now shift focus a bit. Why don't you talk about your own experience with ESG? At Sundaram Alternates, you've been integrating ESG and climate considerations into your private credit portfolio for a few years now. What does that actually look like on the ground? Can you explain that to us, please?
So, honestly, Arjun, our experience has been both challenging and rewarding. And the biggest lesson that we've learned is this: ESG only works if you build it in from day one and not bolt it on later. Every deal we look at goes through ESG due diligence. We identify the material, environmental, and social risks and try to solve for them by engaging with the company. We then bake these solutions into the loan terms, making it contractual. So, take real estate as an example. Every project we finance is contractually required to achieve a green building certification. In fact, part of the loan only gets disbursed once the certification is achieved. And that way, we ensure it's enforceable. But we don't stop at that. We look beyond environment. We look into the social aspects, which is a material topic for real estate. We due diligence close to 60 parameters at the project site, including labor welfare, sanitation, health and safety practices, etc. And the results are real. So by 2025, our portfolio includes 26.5 million square feet of assessed green buildings. And this translates to roughly 19,000 megawatt hours of energy saved every year, nearly a million cubic meters of water conserved annually, and about 8.5 lakh tons of embodied carbon emissions avoided. And this number is equivalent to taking 180,000 cars off the road. But here's what really matters for the investors: these projects aren't just green, they're profitable. Certified buildings sell faster, lease faster, and attract better tenants. And that is a direct value driver. And it doesn't stop at real estate for us. In corporate lending, we take the same approach. For a manufacturer, financing might be tied to energy efficient upgrades. For a healthcare provider, it could mean regular sustainability reporting milestones. And because these terms are contractual, we don't rely on good intentions. We rely on compliance, monitoring, and often third party verification to drive this change.
Those are quite strong numbers. But let's be honest, this can't always be this easy, can it? What problems and obstacles do you face on the ground?
You're right, Arjun. There are challenges. Sometimes borrower push back due to cost concerns or the need for reporting. But once we show them the business case, most of them tend to come around. And over time, they see ESG not as a cost, but as a competitive advantage. And that's the bigger point, right? ESG in private credit is rare because it's hard work. Every loan is bespoke, which means it requires deeper diligence, tailored contracts, and ongoing engagement. But that difficulty is exactly what creates the opportunity. Very few managers have built the systems to do this consistently. And I think, to my mind, that is our edge. So at Sundaram, we've essentially made green finance contractable. Certifications are mandatory, disbursements are milestone linked, impact reporting is non negotiable. And that gives us credibility with the investors and also discipline with the borrowers. It is our true belief that private credit, when done right, can drive climate transition while still delivering meaningful and sustainable returns for the investors.
That is indeed very, very clear. A very clear picture you've painted for us. There's one last question before I let you go. Where exactly does private credit add value in all of this?
So while momentum is real, Arjun, the gap remains enormous. And here's the reality: capital markets today reward the obvious winners, which are solar parks, wind farms, EVs, etc. But this transition requires a whole value chain of companies and depends on hundreds of mid sized players in the ecosystem to keep this transition running. But these companies are often too small for public markets or too complex for the banks, and they're often unwilling to dilute equity. And this is where opportunities for players like us emerge. So, scaling climate finance in India isn't about throwing money into solar or EVs, but the focus has to be on building a broad pipeline of investable companies across value chain and providing them with the right capital at the right time. And that's where private credit comes in. At Sundaram Alternates, we've shown this in practice. By structuring finance that's flexible, patient, and disciplined, we've unlocked growth in the very sectors that are critical for India's climate future. And that ultimately is the opportunity for private capital to step in where traditional finance hesitates.
It was a pleasure to hear you speak, Ramtej. Any final thoughts or key takeaways for our viewers?
Sure, Arjun. The scale of India's growth is enormous. So every year we're effectively building a new city's worth of infrastructure, right? And how we build this new India will shape the global climate outcome. And that means every dollar invested here has an outsized impact, both in terms of returns and in reducing emissions. For investors, that means thinking beyond the obvious, because the most exciting opportunities are in the underfunded parts of the ecosystem, where outcome focused capital can really move the needle on India's climate future. So, the way we see it is this: India's climate transition is a once in a lifetime opportunity, and the rewards will surely go to those who can act decisively.
Lovely, lovely. I thoroughly enjoyed this conversation, Ramtej. Thanks a ton for sharing your knowledge and, more importantly, your own experience around ESG today with us and our viewers. As always, it's a pleasure talking to you.
Thank you, Arjun. It's been a pleasure speaking with you.